What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your daily dose of all things digital assets. The market is moving at lightning speed, and if you're not plugged in, you're missing out. We've got a packed show today with some absolutely game-changing updates that you need to know about. We're kicking things off with a look at the seismic shifts happening in the world of Bitcoin ETFs and what it means for big money entering the space. Get ready, because we're diving deep into the stories that are shaping tomorrow, today. Next up, we're analyzing a fascinating technical indicator that could be flashing a major buy signal. Is this the key to navigating a maturing market and finding those strategic entry points? You'll want to hear this one. Then, we're tracking a significant trend that has investors buzzing. Bitcoin's dominance is falling, and altcoins are starting to surge. Is this the start of a massive altcoin season in which smaller digital assets are poised to benefit? We've got the details. And finally, we're bracing for the infamous Red September. What does history tell us about this historically challenging month for Bitcoin, and are the current market conditions setting the stage for a repeat performance? Stick around for all the critical insights, and make sure you hit that subscribe button and ring the bell so you never miss an update. The ETF effect, reshaping the crypto landscape. The world of digital assets is witnessing a monumental transformation, and the recent surge in Bitcoin exchange-traded funds, ETFs, is at the epicenter of this seismic shift. This isn't just about a new financial product. It's a fundamental reshaping of how institutional capital interacts with the cryptocurrency market, altering market structure and paving the way for unprecedented adoption. The implications are profound, touching everything from asset management strategies to the very accessibility of Bitcoin for a broader investor base. The advent of Bitcoin ETFs has been a long-awaited development, culminating in approvals that have unlocked a floodgate of institutional interest. These regulated investment vehicles provide a familiar and accessible gateway for traditional financial players, asset managers, hedge funds, pension funds, and even retail investors through their standard brokerage accounts, to gain exposure to Bitcoin without the complexities of direct custody or self-managed wallets. This democratization of access is a critical factor, significantly lowering the barrier to entry for billions of dollars in potential capital. Prior to ETFs, significant institutional investment was often hindered by regulatory hurdles, security concerns, and the operational overhead associated with managing digital assets directly. ETFs neatly package these complexities into a regulated, tradable security, making Bitcoin an investable asset class akin to gold or equities for many institutions. The impact on market structure is equally profound. The introduction of ETFs has led to a significant increase in demand for Bitcoin itself, as ETF providers must acquire and hold the underlying asset to back their shares. This constant demand, driven by both new inflows and the need to manage creation and redemption processes, creates a steady buying pressure that can influence price discovery and market stability. Furthermore, the integration of Bitcoin into traditional financial infrastructure means that its price movements are increasingly correlated with broader market trends and macroeconomic factors. Analysts are closely watching how this correlation evolves, as it signifies Bitcoin's growing maturity as an asset class. The liquidity provided by these ETFs also enhances the overall market depth, potentially reducing volatility over the long term and making it easier for large players to enter and exit positions without causing drastic price swings. This enhanced liquidity is crucial for Bitcoin to be considered a viable store of value and a medium of exchange on a global scale. The competition among ETF issuers also drives innovation in product offerings and fee structures, further benefiting investors. The sheer volume of assets under management in these new ETFs is a testament to their immediate success and signals a strong demand that is likely to persist as more firms enter the space and existing ones expand their offerings. The regulatory clarity provided by ETF approval also bolsters confidence among cautious investors, who can now allocate capital with greater assurance regarding compliance and oversight. This regulatory embrace is a significant milestone, validating Bitcoin's place within the established financial ecosystem and setting the stage for further innovation and integration in the digital asset space. The market reaction has been overwhelmingly positive, with significant inflows into the newly launched ETFs. Financial commentators and analysts are abuzz, discussing the potential for Bitcoin to reach new all-time highs and the long-term implications for its role as a digital store of value. The consensus among many is that this marks a new era for Bitcoin, one characterized by greater institutional participation and integration into mainstream finance. But what does this mean for the individual investor looking for the next big signal? Stay tuned, because our next segment dives into a technical indicator that could be your golden ticket. The Mayer Multiple Z-score, unlocking Bitcoin's next big move. As the cryptocurrency market matures, seasoned investors and analysts are constantly seeking more sophisticated tools to navigate its inherent volatility and identify strategic opportunities. One such tool that's gaining traction is the Mayer Multiple Z-score, a metric designed to provide a deeper insight into Bitcoin's valuation and potential buy signals within its evolving market cycle. Understanding this indicator could be the key to unlocking your next profitable move. The Mayer multiple itself is a long-term valuation indicator for Bitcoin, calculated by dividing the current price by the 200-day moving average (MA). Essentially, it measures where the current price stands relative to its long-term trend. When the Mayer multiple is high, it suggests Bitcoin might be overvalued relative to its 200-day MA, potentially indicating a good time to sell or take profits. Conversely, a low Mayer multiple suggests Bitcoin might be undervalued, signaling a potential buying opportunity. However, the Z-score adds another layer of analytical depth. The Z-score, in statistical terms, measures how many standard deviations a data point is from the mean. In the context of the Mayer multiple, the Z-score helps investors understand how extreme the current Mayer multiple is compared to its historical distribution. A high positive Z-score for the Mayer multiple would indicate that the current valuation is significantly above its historical average, suggesting potential overvaluation. Conversely, a significant negative Z-score would point to an unusually low valuation, potentially signaling a strong buy signal. This sophisticated approach moves beyond simple price-to-MA comparisons by contextualizing the Mayer multiple within its own historical behavior. The rationale behind using the Mayer multiple Z-score is rooted in identifying periods of significant deviation from the norm. Historically, Bitcoin has often presented lucrative buying opportunities when its price has dipped significantly below its long-term moving averages, a scenario captured by a low Mayer multiple. By applying the Z-score, analysts can quantify just how rare or common these dips are, helping to distinguish between temporary pullbacks and genuine undervaluation. For instance, a Mayer multiple that falls into a deeply negative Z-score territory might represent a statistically rare event, indicating a potentially opportune moment to accumulate Bitcoin before the market corrects back towards its historical averages. This is particularly relevant in a maturing market where past patterns, while not guarantees, offer valuable insights into cyclical behavior. As Bitcoin transitions from a speculative fringe asset to a more established, albeit volatile, asset class, indicators that account for its historical price action and statistical distribution become increasingly important for strategic decision-making. The Z-score helps filter out noise and pinpoint moments where Bitcoin's price action is statistically anomalous, presenting a compelling case for strategic accumulation. The analysis of the Mayer multiple Z-score is particularly relevant in the current market environment, where Bitcoin has experienced significant price swings. As the market grapples with macroeconomic uncertainties and evolving regulatory landscapes, identifying statistically significant buy signals becomes paramount. For investors looking to capitalize on Bitcoin's long-term growth potential, understanding metrics like the Mayer multiple Z-score offers a data-driven approach to timing market entries, potentially enhancing returns and mitigating risks associated with market timing. Now, as we digest these technical insights, a major trend is unfolding in the broader crypto market that you absolutely need to be aware of. Get ready, because we're talking about altcoins surging as Bitcoin's dominance takes a hit. Altcoin avalanche, Bitcoin dominance dips as new rally ignites. Prepare for a potential seismic shift in the cryptocurrency landscape. The narrative has been dominated by Bitcoin for years, but a significant trend is emerging. Bitcoin's market dominance is steadily declining, making way for a powerful surge in altcoins. This could very well be the signal many have been waiting for, the dawn of a new altcoin season. Bitcoin's reign as the undisputed king of crypto has seen its market dominance fluctuate, but recent data indicates a notable downturn. As of August 24, 2025, Bitcoin's share of the total crypto market capitalization has fallen to 57.69%. This is a significant drop from its recent peak of 66.03% on June 25, signaling a clear rotation of capital away from the market leader and into alternative cryptocurrencies. This trend isn't just a blip. Analysts are pointing to historical patterns where such declines in Bitcoin dominance have preceded substantial altcoin rallies. David Duong, a prominent analyst at Coinbase, has noted that this pattern of Bitcoin dominance falling mirrors historical cycles that typically ignite altcoin seasons. The market is closely watching the Ethereum, ETH, to Bitcoin BTC ratio, which has seen a notable increase, currently testing a critical resistance level at 0.04. A decisive break above this level could further confirm and accelerate the shift towards altcoins. The underlying factors fueling this potential altcoin season are multifaceted. Macroeconomic conditions are playing a crucial role, with the Federal Reserve signaling potential rate cuts and a more accommodative monetary policy. This shift is expected to inject liquidity back into riskier assets, including cryptocurrencies. Coupled with the increasing issuance and adoption of stablecoins, which provide a stable on-ramp for capital into the crypto ecosystem, there's a growing pool of funds available for altcoin investments. Furthermore, evolving regulatory clarity is creating a more conducive environment for alternative digital assets to gain traction and attract broader adoption. These macro tailwinds are creating fertile ground for altcoins to outperform. Several altcoins are already demonstrating impressive gains, underscoring the burgeoning altcoin season. Solana, Sol, has seen weekly surges exceeding 14%, and other projects like Cronos, CRO, have experienced astonishing rallies of over 120% in a single week. The surge in Cronos, in particular, has been linked to strategic business partnerships, such as its integration as a utility token for rewards and subscriptions on the Truth Social platform via Crypto.com. This highlights how real-world utility and adoption are becoming key drivers for altcoin performance. The Altcoin Season Index, a measure used by market watchers to gauge the strength of altcoin performance, has also steadily climbed, currently standing at 61 out of 100. While not yet at the extreme levels seen in previous bull cycles, this upward trajectory indicates a growing investor appetite for altcoins. Institutional investors, having secured their positions in Bitcoin ETFs, are now reportedly exploring second-wave investments in Ethereum and other top-tier altcoins. This institutional embrace adds significant legitimacy and liquidity to the altcoin market, potentially accelerating growth and stability. However, with higher potential rewards come higher risks. The increased volatility, coupled with the ever-present threats of scams and security breaches in the altcoin space, means that careful due diligence and secure storage solutions remain paramount for investors. As we assess these exciting altcoin developments, a familiar seasonal pattern is on the horizon, and it's one that has historically made traders nervous. Get ready to talk about Red September and what it could mean for Bitcoin's price. Brace for impact. Is Red September set to shake Bitcoin's foundations? As August draws to a close, a chilling phenomenon known as Red September looms over the Bitcoin market, a historical pattern that has consistently delivered a punch to crypto traders. This year, as Bitcoin trades sideways, the market is bracing for a familiar script, one that could see prices dip significantly, driven by a confluence of seasonal market behaviors and current geopolitical uncertainties. The September effect, or Red September, is a well-documented anomaly where stock markets, particularly the S&P 500, have historically averaged negative returns in September. Since 1928, it's the only month that consistently shows losses for the index. Bitcoin's track record is even more concerning. Data from CoinGlass reveals that since 2013, Bitcoin has fallen an average of 3.77% each September, experiencing significant crashes 8 times. This historical precedent has led many to predict a similar downturn, with social media chatter often spiking around late August, followed by increased Bitcoin deposits to exchanges, a classic sign of potential selling pressure. This predictable pattern has evolved into what some describe as a monthly psychology experiment, where markets might be talking themselves into a sell-off based on historical data rather than immediate fundamental changes. The mechanics behind Red September are rooted in several structural market behaviors that converge each fall. Traditionally, mutual funds close their fiscal years in September, leading to tax loss harvesting and portfolio rebalancing that can inject sell orders into the market. The end of summer vacation season sees traders returning to their desks, reassessing positions after periods of lower liquidity. Post-Labor Day, bond issuances often surge, drawing capital away from equities and risk assets as institutions favor fixed income. Adding to the mix, the Federal Open Market Committee, FOMC, typically holds its September meeting, creating policy uncertainty that can freeze buying activity until a clear direction emerges. In the crypto market, these pressures are amplified. Bitcoin's 24/7 trading cycle means there are no circuit breakers to halt rapid sell-offs, and its relatively smaller market cap makes it more susceptible to large movements from whales seeking to reallocate profits. This cascade effect often starts in traditional markets and spills over into crypto, with institutional investors dumping Bitcoin first to meet margin calls or reduce overall portfolio risk. Derivatives markets can exacerbate these moves, with a small spot price drop triggering much larger liquidations in futures and options. Adding a layer of complexity this year are unusual crosscurrents. While the Federal Reserve has indicated potential rate cuts, core inflation remains stubbornly high. Furthermore, ongoing global conflicts in Europe and the Middle East are disrupting critical supply chains, and geopolitical tensions are escalating. These factors combine to create what some analysts call a perfect storm. The market's perception of Bitcoin has also shifted. It's increasingly viewed as a risk asset rather than a safe haven hedge, making it more vulnerable to sell-offs during times of global instability. Technical indicators paint a concerning picture. Bitcoin has broken below the critical $110,000 support level, and key moving averages are now acting as resistance. The Relative Strength Index, RSI, is in oversold territory, and trading volumes are below average, suggesting a potential lack of conviction for buyers. However, not all analysts are convinced that history will repeat itself. Some argue that the Red September phenomenon is becoming less potent as Bitcoin matures. Ben Kurland, CEO at crypto research platform DYOR, suggests that historical patterns mattered more when Bitcoin was a smaller, thinner market. He points to the increased liquidity from institutional adoption, particularly through ETFs, as a factor that adds stability. In fact, Bitcoin has registered positive gains in September in the last 2 years, moderating its historical losses. The argument is that the market has trained itself to expect weakness in September, making the sell-off a self-fulfilling prophecy. The upcoming FOMC meeting on September 17-18 will be a key event to watch for market direction. So, while the charts and historical data might be flashing warning signs, the underlying fundamentals could tell a different story. We'll wrap up today with a lightning round recap of all the major headlines you need to know. And that's a wrap on today's Bitcoin Bulletin. We saw the massive impact of Bitcoin ETFs on institutional adoption, analyzed the Mayer multiple Z-score for potential buy signals, tracked the altcoin surge as Bitcoin dominance falls, and braced for the infamous Red September. Don't miss out on any of these crucial updates. Hit that like button, subscribe to the channel, ring the notification bell, and follow us on all social media platforms for more real-time crypto insights.